Hello and welcome to my presentation. Today I will be covering Chapter 5, Gross Income and Exclusion, pages 5-8 to 5-13. The topics I'll be covering are community property systems, types of income, annuities, and property dispositions. A few terms that I would like to cover are community property systems, which are systems in which state laws dictate how the income and property is legally shared between a husband and wife. Annuities are streams of equal payments over time. Earned income is compensation and other forms of income which can be produced from providing goods or services in the ordinary course of a business. Unearned income is income from property that accrues as time passes without effort on the part of the owner of the property. Return of capital is the portion of proceeds from a sale or distribution, representing a return of the original costs of the underlying property. The first topic is community property systems. 9 states implement a community property system. Those states include Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So how do community property systems recognize income and property? Any income earned and property acquired by one spouse during the course of marriage is considered equally earned by both spouses, but inherited or gifted property is separate property. So how is income and property taxed by the federal government under a community property system? So 50% of the income earned by one spouse and 50% of the income from property purchased during the course of marriage by one spouse will be included in the gross income of the other spouse. However, this can vary between states. For example, in Arizona, California, New Mexico, and Washington, the entirety of the income from separately owned property is included in the gross income of that spouse who earned it. But in Idaho, Wisconsin, Louisiana, and Texas, half of the income from separately owned property is included in each spouse's gross income. What if a state doesn't implement a community property system? In that case, they would be implementing the common law system. Under common law, all income from separately owned property is included in the owner's gross income. Income earned from services of one spouse is added to the income of the spouse who earned it. And if property isn't owned separately, it's owned jointly, each owner is taxed based on their share of the property. So let's look at an example problem regarding the community property systems. So suppose a couple resides in a common law state. 1 year before their divorce, they filed married, filing separately. Person A earned $20,000 and person B earned $35,000 annually. How much will person A and person B report on their individual tax returns? So under common law, we know that the income is reported by the person who earned it. So person A reports $20,000 in gross income and person B reports $35,000 in gross income. In the second part of the question, we try to calculate gross income if they live in a state under a community property system. So under a community property system, we know that half of all the income from each spouse is included in the other spouse's gross income. So we add together the annual income of person A and the annual income of person B and divide it by 2. So under a community property system, each couple each spouse would report $27,500 of income. For topic 2, we're discussing different types of income. This includes income from services, income from property, annuities, and property dispositions. So what counts as income from services? Income from services is also called earned income and can be generated from providing goods or services. A few examples of income from services include salary, wages, fees earned through services, and unemployment compensation. So let's look at an example problem. Calculate Dan's income from services using his employment income and self-employment income. His employment salary is $25,000. The income he earned from his side gigs are $700, and his transportation expenses amounted to $350. So to calculate his total income from services, we add together his employment salary, his gig income, and deduct his transportation expenses to get to $25,350. Income from property. This is also referred to as unearned income. A few examples of unearned income are gains or losses from the sale of property, dividends, interest, rent received, royalties, and annuities. How is unearned income taxed? Well, if the income is from dividends, it can potentially qualify to be taxed at the preferential tax rates of 0, 15, or 20%. If the income is from long-term capital gains, they will be given preferential tax rates. Other types of unearned income are taxed as ordinary income. So let's look at an example problem. Sam owns a rental property and earned $15,000 from rental payments from residents. However, he also incurred $5,000 in real estate taxes and $1,000 in expenses. What effect does the rental have on Sam's reported income? So gross income includes all of the rental revenue. So his gross income would be reported as $15,000. His taxable income would be the gross income from rental revenue minus his real estate taxes and then minus his expenses, which gives you $9,000. Annuities. There are two types of annuities, fixed annuities and lifetime annuities. And another type of lifetime annuity is a joint lifetime annuity, which is just a lifetime annuity purchased for two people. Now, in order to determine which part of an annuity is taxable and which part is non-taxable, we would use the annuity exclusion ratio. So you would take the original investment divided by the expected value of the annuity, which would give you the return of capital percentage. So let's look at an example of that. So to calculate the annuity values of a fixed annuity, we would take the original investment and divide it by the number of payments. And calculating the lifetime annuity, we would take the expected return multiple from the table on the left and multiply it by the annual payment amount. So suppose you purchase a fixed annuity that pays $12,000 per year for the next 10 years. You receive the first payment in December. The original price of the annuity costs $80,000 and will pay a total of $120,000 over the life of the annuity. How much of the $12,000 payment must you include in gross income? So just like the formula examples that we saw before, we would take the original investment of $80,000 and divide it by the number of payments, which is 10. That gives us the return of capital per payment, which is $8,000. Now, the amount that we received in December was $12,000, so we would subtract the return of capital payment from the $12,000 to arrive at the amount that would be included in gross income, $4,000. So finally, we will look at property dispositions. So taxpayers generate a gain or a loss on the sale of an asset, and they may recover the tax basis, or the original investment, in the property before they realize a gain. So let's look at the formula on the left. We would take sales proceeds, subtract selling expenses to get to the amount realized. Then we would subtract the tax basis, or the original investment, from the amount realized to get to the gain or the loss on the sale. In conclusion, the various topics in Chapter 5, which concern gross income, were extremely informative. The facts regarding annuities and common law systems will be applicable to my future and my daily life.